What's going on, everybody? This is James Nash with Official Trader here. So I said I was going to make a video yesterday and didn't get a chance to, so I got it coming at you today. So if you notice the board behind me, if you can see that, moderately, I'll keep it on there for a second. You have the positions in my forward strangles. So we're going to talk about something called, if you're a stock trader in general, it's called averaging down, right? So say you bought 1,000 shares at $50 and it turned around and went down to $30 and it stayed there for a while. You could go ahead and pick up more shares at 30 if you felt comfortable that the price was going to stay there and then rise again. Now, if you're not at a bottom and it's continuing to drop, obviously you want to wait. So what that's going to do is put your total average cost down. Okay, so you can do the same thing with options contracts and calls and puts, strangle straddles, maybe iron condors. Haven't done that before on those. But anyway, yeah. So we're going to go through this. I'm going to try to keep it fairly simple. You can see the numbers we got here. Hopefully it doesn't zoom in and out too many times. So I bought two initial contract strangles. That's where you buy a call and a put at the same time. And I straddled the price pretty tight. Remember, this was $8.50 put to $9 call. So I'm not worried about the break-even prices because the contract was out till March 1st. I've now closed it all. And I just want to explain, if you fear the red and you run from the red, say you're down even a large chunk of the position, it's okay if you have time in the option. If you feel strongly that, the position was open for a reason, as I said, you want to know what your in and out should be, right? So the beginning price of this, when I started looking at it, was about 75 cent per contract, times 100, so that's $75. It dropped down to 55. I felt like that was a pretty good place to get in, but I only opened up two. I want to just keep it safe. That was a $110 position. And so I'm looking at March 1st expiration, so that's a nice window. The stock price, literally, I've never seen it stay like it did for so long. It stayed in between 860 and 880 for, it felt like forever, but it was just a couple weeks. Because the market dove hard in December, Ford recovered in January, and then I was holding a position, and then February came around, February 1st, I think is when I closed this. Anyways, let's get into it. Two contracts, 55, the price, dropped down pretty hard, so I picked up four more at 39, still leaving a good bit of room, and then I closed out a few other positions at a small profit just to have a little bit of extra leverage there, and then I came down. I added two more at 39 because it stayed there for a minute. So I'm averaging 55 down a lot here. So now my average was like 42. It dropped again. Man, now I'm getting kind of frustrated, but I'm still, still in hopes because I know that I have expiration time. It's only about to go into February, and then March 1st was still a good while away. Full month, at that month you want to be gauging what you're going to do with this position, right? So I went ahead and looked at three more at 30. That was, so you're looking at 110, 152, 78, 90. So I'm kind of throwing money at it, but I'm still averaging the position down. My initial cost is still going down. So that way, if it does just pop out of nowhere and the option implied volatility pops and it gets me back to at least break even, I can get out, okay? I can be safe. I want profit. Like I said, I don't want to settle. I don't like losses, period. And I don't like to break even. I really want it. I don't care if it's a 1% profit. I just want profit. All right. And momentarily, if you get that, you'll be better. It dropped again, 28. And it dropped again, 25. Now, this is the bottom. It hit 24 and didn't go down any further. I think it might have tagged 21 for like a second. But I had a limit order to pick up a bunch of them at, I think it was 21 or 22. And it didn't go that far. And I tried to get them at 13 at 24. But I went ahead and put the market order in at 25, picked up 13 more, and that 13 contracts at 25 outweighed a lot of this here. So you got 6, 8, 9, 10, 11, 12, 13, 14, 15 contracts versus 13, and I averaged that price way down. My average price became 34, so that was good. Now, had I closed this when I woke up that morning, it would have been a lot better because I was up an additional $111 on the day, and Ford started to recover. This was just a couple days ago. Ford started to recover, and I could have closed out with a little more profit than what I did. But now actually I did the numbers. I know that I actually walked away a little better than I thought I did. I thought I only had about 8 or 9% because I couldn't remember what I sold them at until I looked back at it. So I was down over three. It was $320 at one moment. I was down the whole position, right? Down $300+, even with these additional contracts, because it probably stayed there at about 25, 26, 25, 26. And it was fluctuating. Then I noticed the curve and the good old fish hook, coming up. And sure enough, Ford popped up. And then, whew, sunk down. And it went all the way down to 820, 819, something like that. And that was when I could have cashed out at the extra 110 for the day. But what I did to stay on the safe side of this was, once I got in that position and it rose back up, it popped to 35. It got at 37, but I put a limit. I got rid of 20 contracts at 35, so that just decreased my risk altogether in this position. Now I only have 11 open contracts, that I have to worry about. And this was the ones where it got all the way up to 42. And, well, I waited a little bit, and then Ford actually did start to recover, in the positive and go back up. And so I went ahead and got out. So now it's sitting around 837 again. So I got out at a good time regardless. I made a good decision. I should have cashed out that morning when I woke up. I just got off work that morning. I only slept for like 2 hours, so I was pretty tired. But that's what you got. My total cost for all these positions together was $867. All right. That's a total of, I think it was 31 contracts total, $867. Closed out 20 at 35. I didn't get to pick up that last $110 profit on top of this, but I closed out the other 11 at 35 because I noticed it started going back up. Therefore, the premium started to go down. Now, I didn't want to get this back to 34, 33, 32, 25, and end up getting hurt on my position and then have to wait it out even more, because Ford could recover. They're doing a lot of different things. They're hiring, a bunch of people, putting $1 billion into something here and there with employees, even though they are, not pulling out of Europe apparently. What all these other things going on, but you have to just gauge the market, kind of see what's going on. But I actually closed all positions for a grand total of $1,085. That's $1,085. So after calculating, I made $218 profit, right? That is 20%. I had this position open for approximately 2.5 weeks, give or take, I think it was 3 weeks. So yes, I was down $308. That was the constant, but it did touch 320 and 330 at one point. And I got kind of nervous. GE did the same thing. And I capitalized on GE and got out with a profit on that one as well. It was down. My whole account was, it shrunk $500-something because of these two positions total, with all these contracts here and all the contracts I had on GE. I had 10 on GE, and they were just calls, So the moment that price spiked back up to 1060, I got out and I took my profit and ran. If you stay in the position to expiration, you're really risking possibly your entire position, account value, not account value, but entire position value. Because if it expires under the price it's supposed to be, then you're out of luck and you're probably gonna lose all your money. So running out of time here. Anyway, so don't run from the red, okay? This negative $308, that would scare most of you straight out of the position altogether, right? Well, I knew to be patient. I knew that Ford would recover. I know the patterns of Ford stock, and that's the thing that helps, is that you kind of know what you're trading. You don't just pop on the Apple that you've never traded an option on before just to watch the price go the opposite direction when you had no real inclination of what was going to happen, right? So opened up 867, closed at 1085. Like I said, this would have been about $1,200, but I kind of got out a little late on that. I should have went ahead and cashed out that morning, while it was on the heavy rise for the premium. A lot of people were dumping money on it, and by lunchtime the price was shooting back up. It got to 837, so I got out, and that was a good thing. I don't know if it's going to drop again. I feel like it's going to touch 780s where it was in December if all goes, earnings-wise, they go negative like everybody's thinking they are, go down. So this stock price could possibly get back to the $7 range. I think it's 780s. Maybe it'll touch that baseline and come back up. I'm not sure. If it touches 6 again, that's going to be a heavy strangle. I've got several open orders that are already limit buys, ready to open up more strangles against Ford. Love this position. Very, very simple to make, 10, 20, 30% profits. The better the position. Now, if I would have bought this 13 at 25 originally and then sold at 35, well, that's $10 per contract, right? That I made profit on. That's amazing. That's wonderful. All right. So every time at 10, every time that move one, that's 10. That's $10 every time. And now I got 10. So it moves. It's $100. You know what I mean? Anyway, I hope you guys get this. I hope you understand. I hope you see that don't run from the red. If you run from the red, you're going to hurt yourself. If I'd have sold this position, boom, I'm down $300 right off the bat, right? If I'd have sold G's position at negative $310, boom, negative right off the bat, I would have lost $600. Come on now. Now, for some of you, that's not a lot of money. Some of you play with $10, $20, $40, $50,000, and it's not a big deal. But for me, starting off with this little baby account that I had in this thing at 20 bucks, slowly put a little here and there, but now I'm trying to organically trade based on just my profits, and it's slowly going up, right? I get kicked back a little bit here and there with the markets, you know, and then I go back up, make a few real nice $400 or $500 trades, and boom, even like this, you know, 20%, boom. That equates to right at about 20.01% profit on this return. That is tremendous. The GE position, I think I did close out on about 8 or 10%, but I still walked away with profit. I did not walk away with a loss. I did not walk away breaking even. I was patient. Very important lesson. Patience is a virtue for real when it comes to trading. Don't bypass that. I hope you guys enjoy this short video. Hope you understand what I'm talking about. This process was called averaging down the cost of your position, right? And now if you're selling puts, I don't really think you can do that, but buying calls and puts and strangles and straddles, it does work because essentially you're just buying at a lower cost. Just like I said, when a stock drops from 50 to 30, and that's the baseline, and it starts to rise back up, it's got nice support. You pick them up, you know, say 1,000 at 30, you just average your position, you'll probably be around 40, right? 40 average, and it pops back up to 40, you just got your money back. And then you made a profit on top of that if it goes back to 50, all right? So now if you bought 2,000 at 30, then that original 50 would average way down, so your average would be 32, 35, somewhere in there. And then you're in a really nice position. But again, that's why I trade options. I'm not looking at stock. I don't trade stocks like that because there's no room for rapid expansion when it comes to account because you can only make money when the stock goes up. Now, if you bought 20,000 shares of a 5-cent stock and it goes to 30 cents, yeah, you just made a freaking killing. But it's very difficult, you know, despite what all these people say. A lot of people get lucky. You know, I don't short stocks. I don't, you know, say, hey, loan me this many shares and I'll sell them back to you at a lower cost or higher cost or whatever, you know, to take the profit because I don't feel, a lot of people make a lot of money off that, but you can really hurt yourself on that altogether. This is very simple stuff. Options are not that difficult. Real Fish Hook Trader, email me, thefishhooktrader@outlook.com. Join the program. Got a 1-year annual email subscription. I don't flood your email with a bunch of spam or nothing like that. I'll give you some ideas of what I'll be trading, not direct trading advice, not telling you to trade those positions, just letting you know what I will possibly be doing based on what I'm seeing in the market or on those positions at the time. And I'm not going to tell you like right after. I'm not making money off of you by buying in, none of that. That doesn't make any sense. So yeah, why am I charging? Well, if you're good at something, don't do it for free. I mean, that is kind of the principle of it. That's why business runs in the first place. So yeah, here you go. Strangle straddles, calls puts, whatever your directive, whatever your poison. So 867 in, 1085 out, $218, 20% profit. Get it.